What's up, everybody? It's Jack Shores, your number 7 in chat. This is kind of like a test run YouTube video lesson. I figured I'd do a little something on trading, maybe drop a couple things that have been happening in the market lately, see if maybe I can help you guys or like share what I've been seeing lately, and you can apply it to your own trading and maybe fix some of your own problems that you've been having. So let's start with CARV, CARV. So as you know, it often fails a lot of its spikes, and I think right there was actually its new highs, or the previous highs on pretty heavy volume. Big gap broke through, volume was surging about 30% over that, and then it got sold into all day, and it gapped up and spiked the next day, and when it was trying to break out into new highs, it actually made new highs, but they weren't sustainable because the volume was less, the buying pressure was lower than the previous day. So when that happens, typically the sellers are going to come back and control once all the over-aggressive shorts are squeezed out. And that's kind of what we see here. And I was actually trading it. I think I actually longed it right here in the consolidation and was selling into here. It was kind of a crazy morning, so I wasn't super glued to the morning action because I was in and out of my computer. But this is where sizing becomes incredibly important and picking what's comfortable for you and your trading style. So I think I actually shorted a little bit in here in the 40s. Covered it because I had to go move my car from the city streets before I got towed. But it broke down, and then it broke down again, and then it began having a retest. So I began taking a couple more shares into here after the fail. But as you can see, it slowly began uptrending. And I think I only had like 2,000 or 3,000 shares at the time, which that's a good amount of dollar market value for the position. That's about what, like $70,000, $100,000. And as you can see, it's just uptrending and pushing up against this. And you can kind of see where a lot of people are beginning to size in. They're thinking, other shorts are saying, okay, we have this good range that's building up. But so it just slowly builds up against them. And if anybody's oversized, they're going to be controlled by emotions. And as it pushes up past that, you get this quick pop where they're stopping out when the volume just it spikes a little because shorts are stopping out of their oversized positions, or maybe buyers are coming in to try to push the stock up even higher. But then it slams back down with a big fake out, and so when that consolidation breakout fails, there's going to be extra longs up here, and then shorts are going to want to get back in, which creates an even bigger selling pressure going down. And meanwhile, with my position, it was 3,000 from like a 37 average. So while yes, the loss was getting up a little bit, I would have been just as okay taking it up here, and because that was in my trading plan. Whereas if I had like a 6,000 or even 10,000 share position from 37, up there I would be down 30,000, and I really would not want to be cutting my 10,000 share loss at 42 because then that would turn into like a $60,000 loss. Maybe even if there's slippage in a halt, it could be a $70,000 or $80,000 halt or $80,000 loss, which it could even be worse if it just keeps halting because this is a low float. So by having a smaller position, I'm able to stay in there. I'm not taking an unnecessary loss, and I'm able to capitalize on a great setup that just failed for the rest of the day. And I think I finished the short side of the trade making about $40,000. So that was a really good example of why sizing matters, because trading is all about risk management. But people will often say, okay, yeah, you look at the chart, I'm going to short here at 38, 39, my 1,000 shares, and risk against 43. That's about $4 a share loss on 1,000 shares, so $4,000. But they just see the low of day and they say 24, so I can make 39 minus 24, so like a $15,000 gain. But you never really know that it's going to come down this far I think I maybe covered up a little bit, added into the bounce, and added back on, and that's perfectly acceptable because the trend was completely changed from the morning action. So with risk management, there are a few very key components. It is the proper sizing, the proper plan, and one thing that is really not talked about is the proper timing. So with day trading, it is all about your timing. So you can have the right plan, the right thesis, the right setup, but if you chase a stock down or up, your timing is going to be so off that when the market just moves in its natural way where it's going up and down, it's going to probably shake you out, especially if you're oversized. So in my opinion, it goes the timing and then the sizing part of risk management. So like for example, if I see that and I see this little box right here, this consolidation from 1019 to 1054, and it breaks down. Now I get frustrated because I wanted a bounce to add, and then I end up adding here at 30. It squeezes all the way back up here to 32, and that's nearly a 10% increase over from where you initially added at 30. So this is why it is so important to have the mindset that you would rather miss a trade or miss an ad rather than just forcing it and going in, because that's a very easy way to make unnecessary losses. I think that's going to be just about it for this quick video lessons. I'm at about 7 minutes right now. I was thinking it would only be about 3 minutes. But yeah, let me know what your favorite takeaway from the video is. All 20 of the views I'm probably going to get. And then also comment what you would like me to talk about as we go further into the week, because I figured out YouTube and it seems like a pretty easy process. So I'll probably try to make a weekly or bi-weekly video lessons for you guys. Thank you. Have a good day.